Hey guys, Chris and Jason here from Hard Money Bankers, here with some more video tips to help you in your real estate investing career. Today we are talking about your purchase price. Everyone knows in real estate investing you make your money when you buy. Yet, here at Hard Money Bankers, when people are coming to us for financing, we see too many people buying too high. They're paying too much for the properties they're looking to acquire.
Yeah, and I mean, one of the reasons they're probably thinking they need to pay too much is because it's a competitive marketplace.
Sure.
And, you know, I'm not gonna lie, it's hard to find deals out there, and most of the time they're just not marketing or doing the proper things to find those deals, but you know, that's a different subject. The issue is you know, you can't pay too much for a property because you will lose, and you know, these are facts, these are not my opinions. You know, the rule of 65% minus construction costs was just not made up or pulled out of thin air. You know, that, like, you have to buy at right about 65% minus construction costs.
You want to break that down a little bit more?
Sure.
65% of that after repair price, what you expect to sell for.
That's right.
In essence.
Yeah.
Minus what you plan to spend on construction equals what you can pay for the property.
That's right. And without boring you with detailed numbers on a broad level, you know, if the property's going to resell for $200,000, that means that you need to buy that thing at 130 minus construction costs. So assume your construction costs are $30,000.
Yep.
You need to pay $100,000, and that's what experienced real estate investors are buying.
Right.
Because the 100 and the 30, you know, acquisition construction combined, it's $130,000, right? And then you're going to have some lender costs of, you know, a few percent, like 5% all in. Call that 5% transfer and recordation tax if you're paying cash or you're not paying, or you're using financing. It's the same.
Sure.
You're going to have some interest carry costs. You know, if you're using money, you know, let's call that a point or something a month. There's another 5 or 6% there, plus another 2% for holding costs. You know, you got to pay your utility bills, your water bills. Things like that. So all of a sudden, that 130 number turns into like 165, 160-ish right off the bat. And
Yep.
It's a little bit less if you're using financing and you're only using your own cash, but nevertheless, you know, that gives you, like, I don't know, if you're selling at 200, it's giving you $30,000 to $40,000 in real numbers at this point, not including the back end costs, which are realtor fees that could be anywhere between 4% and 6%, trans and rec, which is another, or not rec, transfer tax,
Sure.
plus other stuff, which is 1.5%.
So automatically that 70,000 gross profit that you see is cut in half and it's 35.
Right there, yeah.
Right off the bat.
Yeah, right, yeah, at least right off the bat. So it's you know, the majority of it's on the front end, and then you have, you know, what we just talked about, let's say 5% realtor, 1.5% transfer, and some other title fees. That's another, you know, what's that, 10 G's or whatever the case is off that. So you're at about $30,000 profit, which is still a phenomenal profit, don't get me wrong.
Yeah.
But there's big things that aren't taken into consideration. Cost overruns, which always happen.
Right.
This is best case scenario. Like, these are factual numbers, best case scenario.
Going over on construction number one.
Yeah, exactly.
Without a doubt.
You know, so construction going over budget is true thing. Going over the timeline, you know, time is money.
Which increases your financing costs.
Exactly.
Right.
Or anything, or you know, holding costs, your bills. You know, another tax
Sure.
bill is due, another insurance bill is due, and in this market, you know, we see a lot of seller subsidy. So that didn't take that in consideration either, which could be 3%, which could be, you know, another $6,000 in that.
Right.
So again, you know, those are the numbers that work, and you're probably going to profit $30,000 or whatever the case is on that, which is great. And
no, it's great money.
You know, you know, if you're using your own cash, or you're using a hard money lender, you need a little bit of cash, or if you have a partnership with somebody else and they're putting up all the money, you know, the rate of return on any single one of those situations is a ridiculously good rate of return in all ways. But keep in mind, those are true, you know, factual numbers based off of 65%. You know, all of a sudden you get to that 75% number, which is a little bit higher, and you know, that profit's pretty much gone. I mean, in a best case scenario,
and we see that a lot, right?
Yep. In a best case scenario, it's 75%. Those exact kind of figures and the same numbers I just went across. You have a best case scenario of making $10,000 on those exact same numbers. not including seller subsidy. So all of a sudden, if you have a seller subsidy, that 10 grand is pretty much wiped out. If you go over a little bit in construction, that's wiped out.
And also keep in mind, like doing a 6-month project and that much time and effort and risk by putting everything into it probably isn't worth it for a $10,000 profit.
Absolutely.
You probably would not go into that deal if you knew that was your outcome.
Exactly. And some of the rebuts that would occur is, well, I don't need 6 months. I'm going to get this thing done in 2 or 3 months. And that happens. Don't get me wrong.
It happens, but not much.
Exactly. And they also say, oh, well, I'm buying that may work on a $200,000 ARV. I'm buying a $500,000 ARV. So, I'm going to take percentage. I'm going to take percentage out of the mix because
the dollar figures are bigger.
Exactly.
Right.
So that $30,000 turns into $100,000. So if I mess up here, but at the same time, it's a $30,000 construction project goes over budget, 10 grand, it's 10 grand. A $100,000 construction budget for the goes over $30,000. So you still got to look at this as a percentage basis.
Sure.
To be smart. So we see probably the magic number being about 70%, 70 to 72%, no higher than 72%, but about 70%.
Obviously you want lower, but it's just very hard to find the deals.
That's right. So you do risk versus reward, and if you can, if you're an expert and you can really get in and out of this thing quickly, you can fudge numbers a little bit. But 65% is what you want to base it off of. If you got to go up a little bit higher, do so. But now that we all know that if you get as high as 75%, there's a good chance that not only you're breaking even, but you're actually going to lose money on the transaction.
Yeah, so remember those numbers. 65% is ideal, 70% is doable, and whatever you do, make sure you're super, super tight on that ARV, because all those numbers are out the window if you're wrong about your ARV. If you think it's 230 and it's more likely 2, you're not getting into the right deal.
Exactly.
So be very careful, be conservative, even pessimistic about ARVs, and do your numbers based on that.
Exactly. If you're local, Maryland, Virginia, DC, Pennsylvania, and our newest state, New Jersey.
Now Jersey.
South Jersey.
Found out we were lending in Jersey this week.
Reach out to us if you want a strategy session, either with myself or with Chris or somebody else from our organization. Happy to help you out with any deals that you have. Give us a shout, hardmoneybankers.com. Call the office, 800-883-8290. Jason, Chris, Hard Money Bankers. Peace out.